All right, let's talk about 0-day to expiration options, or as pretty much everyone calls them, 0 DTEs. For a lot of people, these are just a straight-up gamble, right? A lottery ticket with a ticker symbol. But what if I told you there's a way to peel back the chaos and find a real, repeatable edge? Today, we're going to build a framework to do just that, to stop gambling and start trading these things with a data-driven plan. But first, you know the drill, we have to get the important legal stuff out of the way. Please remember, nothing you see here is financial advice. This is all for informational and educational purposes. All trading carries a ton of risk, so please do your own homework and understand what you're willing to lose before you ever place a trade. Okay? Good. So let's dive right into the heart of the problem. We're calling this section the 0 DTE lottery for a reason. Most traders, and I mean most, treat these options exactly like that. They see that huge potential for a crazy return in a matter of hours, and they just dive in head first, completely blind, just hoping to get lucky. And I think we all know how that story usually ends. It's a surefire recipe for blowing up an account. So, are they just gambling? Well, let's be honest. If you're just randomly buying calls or puts based on a gut feeling, then yeah, it's 100% gambling. You might as well be at a casino. But here's the secret. The professional edge exists because so many people treat it that way. Their chaotic, emotional trading actually creates predictable patterns for those of us who have a system. So that's what we're here to do. Build that system and move from guessing to executing. Now, before we build, we have to understand the foundation, and that means respecting the massive risks here. First off, rapid decay. You've heard of theta, right? On expiration day, it's not a slow leak. It's a fire hose, just melting your options value away every single minute. Second, volatility explosions. Some unexpected news hits the wire, and boom, any beautiful setup you had can get completely wiped out in seconds. And finally, there's low liquidity. Those super cheap, far out-of-the-money options, they can be a trap. The pricing is awful, and it can be almost impossible to get out when you need to. You have to know these risks inside and out. It's step one. Okay, so how do we navigate this minefield and find a real edge? Well, we start by following the footprints of the big money. We need a map that shows us where the major institutions, the giant funds, are placing their bets. And that map, for us, is the volume profile. Now, this is not the little volume bars you see at the bottom of your chart. Nope, no. This tool is way more powerful. It shows you exactly how much volume was traded at every single price level. It's like an X-ray of the market. And on this entire map, there's one landmark that matters more than all the others. It's called the point of control, or the POC. This is the single price level where the absolute most business was done. Think of it like the market's center of gravity for the day. And because institutions put so much money to work there, it acts like a powerful magnet for price. They have a vested interest in defending that level. So our map really comes down to 3 key landmarks. We've got the point of control, our main magnet. Then you have the value area high, or VAH. Think of this as the ceiling. It's the top of the zone where 70% of the trading happened, and it often acts as resistance. And then you have its opposite, the value area low, or VAL, which is the floor. It often acts as support. These 3 levels, that's it. They give us a clear, simple, and actionable structure for the market. Now here's the real key, the part that a lot of traders miss. We don't just look at today's map in real time. We study yesterday's map. Why? Because the market has memory. Those giant institutional positions that were built at yesterday's levels, they don't just vanish overnight. Those institutions are often going to defend those positions the next day. So yesterday's POC, it becomes an incredibly powerful magnet for today's price action. This idea right here, it's the first pillar of our entire system. And that brings us to pillar number 2. This is a force that is pretty unique to options expiration day, and it's called gamma pinning. Okay, stick with me here. If you think of an option's delta as its speed, right? How fast its price changes, well then gamma is its accelerator. And on expiration day, with the clock ticking down to 0, that accelerator is pushed all the way to the floor. This creates a situation where market makers are forced to constantly buy and sell stock to stay hedged, which creates some really interesting effects. And this right here shows you why 0 DTEs are just a totally different animal. Look at a 30-day option. The gamma is pretty tame, the price moves are gradual. But a 3-hour option on expiration day, the gamma is absolutely massive. It's explosive. And this creates a powerful feedback loop. The more the price moves, the more the market makers have to hedge, and paradoxically, all of that hedging can actually kill volatility and literally pin the price to a big, high-volume option strike. And just so you understand the scale we're talking about here, it's absolutely insane. Right now, 0 DTE options account for somewhere between 40 and 50% of the entire daily options volume on something like the SPY. Just let that sink in. Nearly half of all the option bets are being placed and settled on the same day. This isn't some small niche strategy anymore. This is a massive force that is literally bending the market around it.
So, this brings us to the Holy Grail. This is the secret sauce for this whole system. When our institutional map, that point of control from yesterday's volume, lines up perfectly with our expiration magnet, a strike price that has a ton of open interest and gamma, you get this incredible confluence. And that creates what we call a high probability pin zone. That is our #1 target for the trading day.
Okay, so we've got our map, the volume profile, we've got our magnet, the gamma pin. That's all great theory, but theory doesn't make you money, a plan does. So now let's put it all together into a simple daily framework that you can actually use every single morning.
So we're going to break the trading day into 3 simple phases. Phase 1, pre-market analysis. This is your homework time. Before the bell rings, you find yesterday's POC, you identify today's high open interest strike, and you mark your potential pin zone on your chart. Phase 2, the conditional trading window. This is huge. You don't just jump in. You wait. You patiently wait for price to give you a setup to trade towards your zone. We don't chase. We let the market come to us. And phase 3, this is the most important rule of all, the final hour exit. By 3:30 p.m. Eastern, you are flat. No positions, no exceptions. We book our profit or our loss, and we live to find another day. We completely avoid the chaos of the final 30 minutes.
Now, what's cool about this framework is that it gives you a few different plays you can run. First is the compression trade. If the market opens way far away from your pin zone, you can actually play for that reversion, that move back towards the magnet. Second, the value area test. You can trade a bounce off of yesterday's floor, the VL, or a rejection from yesterday's ceiling, the VAH. And finally, you've got the pin range trade. This is usually for the afternoon. Once price gets trapped inside that pin zone, you can actually scalp the tight little range it creates. All right, let's bring this all home. What we've really been talking about this whole time isn't just one strategy. It's about a fundamental shift in your mindset. It's about making a conscious choice to stop playing the slot machine and start acting like a professional who runs a disciplined, process-driven business. And this table just lays it out, plain and simple. The gambler, they're just guessing direction. The systematic trader is using confluence to find a high probability zone. The gambler is hoping for a miracle. The trader has a defined risk management plan before they even enter. The gambler throws way too much money at cheap, out-of-the-money lottery tickets. The trader manages their position size strictly. And maybe the biggest difference of all, the gambler holds on till the bitter end praying, while the trader exits based on a time rule, protecting their capital. So if you only take one single thing away from this whole explainer, please let it be this. Your edge in 0 DTE trading is not about being some kind of guru who can predict every single up and down move. That's impossible. The real edge is in becoming a detective, a map reader, who can simply identify the zone where all these institutional forces are most likely to squeeze and compress price by the end of the day. So I'll leave you with this one question to think about. Next time you pull up your trading platform, ask yourself, are you methodically building a system with rules and edge and risk management, or are you just walking up to the counter and buying another lottery ticket? The choice and the results that follow are 100% up to you. Hey, if you found this framework helpful, do me a huge favor. Hit that like button, share it with another trader you think needs to see it, and make sure you subscribe to my channel, Elite Trade Radar, for more deep dives just like this one. Thanks for watching.